Hey everybody, Mike DeSepoli, Heritage Financial Advisory Group. Welcome to the Heritage Market Update for Friday, December 9th, 2022. We're here to update you on all things markets and economies. There's been a lot going on this week for financial and economic data. We want to share some of that with you today. And next week is an even bigger week when we look at the economic calendar. So there's certainly going to be a lot for the market to digest over the next couple of days. The big news of today was we had the monthly PPI, which is a producer price index report. So kind of like the cousin to the CPI report. CPI looks at the consumer side, PPI looks at the producer side. We were looking for a gain month over month of 0.2% in the PPI. It came in slightly higher at 0.3%. And now, a few months back, this type of higher reading probably would have killed the markets because any hints of higher inflation were just an absolute death knell for stocks. But the market seems to be taking this so far so good today, taking it in stride. Markets are relatively flat because many economists would argue, and CNBC was making the case this morning, that the PPI is not always a great read into inflation on the consumer side. So when we look at the economic calendar, so today, Friday, December 9th, right, we had the producer price index final for the month. When we look at next week, it's a very big week. So on Tuesday morning, 8:30 in the morning, we have the consumer price index, right? So that is just a critical report for the market. If you remember back on November 10th, we had that first CPI report that showed inflation was finally starting to roll over. Markets loved it. We got a big rally off of it. And now it's going to be another time here where the rubber will meet the road and the market's going to get a look at the most updated CPI figures. What are we looking for? What is the market looking for? Naturally, we want to see continued progress with inflation moving lower and lower. What the market would not want to see is a very hot CPI number where we reverse the declines of last month and end up at a new marginal high. So that would be a bad scenario for the market, which would suggest that inflation has not rolled over. But if inflation continues lower, that is something that will give the Fed a little bit more breathing room with their economic and fiscal policy. And that ties perfectly into next week's economic calendar because we have the CPI on Tuesday morning at 8:30 a.m. And then Wednesday, we have our next we have our Federal Reserve meeting with a press conference from Fed Chair Jerome Powell. So, markets always go wild when Powell talks, lots of volatility, and a lot of what he's going to be able to say on Wednesday is going to be determined by how that CPI looks on Tuesday. Markets are currently pricing in a smaller interest rate hike for December. So we've had a series of 0.75% interest rate hikes over the last couple months. Markets are pricing in, the probabilities are pricing in a 0.5 or 50 basis point hike. Whether he goes higher or lower than that will certainly create an outsized reaction from the markets. But as of right now, when we look at the Fed funds futures markets, that is what the market is suggesting has the highest probability. It's about an 80% probability right now, according to Fed funds futures, that the rate hike this month is going to be 0.5%. Now, we've seen in recent days more and more folks coming out, a growing chorus of people that are pointing to a nasty recession next year if the Fed over tightens. And these are just not anybody, folks. These are CEOs of the major banks, Jamie Dimon from JP Morgan Chase, David Solomon from Goldman Sachs, and Brian Moynihan from Bank of America, all in recent days came out and said, if the Fed continues higher for longer with interest rates, we're going to have a nasty recession. And even Elon Musk chimed in as well. He thinks the Fed should cut rates immediately, that they've already over-tightened. Remains to be seen if that's the case, because obviously all this data that the Fed is dealing with is lagging. So let's take a look at the markets. Obviously, that's what we're here for. So here's a view of the markets looking back at 2022. This is the S&P 500, right? So markets are really, having some work here with this 200-day moving average, okay? The 200-day moving average is this blue sloping line here, and it's a technical indicator that's very widely followed in financial markets. And the belief goes that if an asset is above its 200-day moving average and staying there, that it's in a confirmed uptrend, and when assets break below their 200-day moving average and have trouble getting back above it, they're in a confirmed downtrend. Now, I don't think that anybody would be surprised to hear that the market is in a downtrend this year. That's been very obvious to any participants in the market. And we've had a few attempts here to get above this 200-day moving average, right? We had the rally in March where we got above it, but just couldn't hold it. There was not enough buying conviction to continue to propel us higher. We had the midsummer rally that ended mid-August where we went right up into the 200-day moving average, kissed right off of it, and rolled over, made new lows. Now, we're back at that level again. Now, I know if you're looking at the first two iterations, you're probably concerned that we went above it here and have rolled back over. This needs a little bit more time to resolve itself, in our opinion. Now, when we zoom in a little bit, you look at the last week, it's really just been this past week, and I'm just going to take this off here so we can see it a little bit better. This week has basically encapsulated 2022, right? Markets have gone everywhere and nowhere at the same time over the last, let's call it 7 to 10 days. So we remember about, I think it was November 30th, Fed Chair Powell spoke at the Brookings Institute. He uttered a couple of dovish words about possibly slowing down the pace of monetary and fiscal interest rate hikes, and markets exploded, right? Just an absolute rocket ship, exploded from about 3940 on the S&P almost to 4100. And then what did the markets proceed to do in the days that followed? Give the entire thing right back. And we are basically right now where we were before that meeting, right? So a lot of gyrations, a lot of volatility, and we're in the same spot. Now, this can be viewed two different ways, right? Anytime a market surrenders a big gain, we don't like to see that. That can cause us to lean bearish a little bit. But others would argue that the market is really just hanging out in this range here. And let's zoom out a little bit. All right, here's that big jump on CPI, November 10th, right? We had a good CPI report, market surge, and we've really kind of been consolidating in this range since then. So this is why next week's CPI and Fed meeting are critical for markets, because they will determine where the markets go next. Will this market continue higher, or will this market again run into some overhead resistance that'll send us lower? So far, off the lows, and this is the October 13th lows here. So that was marked on a bad CPI number, and we reversed on that. Then we had a good CPI number here in November. So the December one's very critical. But we've noticed a little bit of a structural change in the markets coming off of the lows. We're creating a rally off the lows, obviously, and we're seeing what we call higher lows, right? So when you have a rally, or when you have any asset that's moving up, what we want to look is when it pulls back, right? Because nothing goes straight up in a straight line. When it pulls back, does that low, cycle low, break the initial low, right? And if you look at this chart here, right, here's the initial low. We shot off of it, we pulled back. Then we move higher. So this was a higher low, meaning that this low was higher than this low. And we moved higher again, we pulled back. We made another higher low coming off the bottom here. We shot up, we pulled back, another higher low. So if you look at this, folks, this has created a very nice trend line here where we have a series of higher lows, right? Whoop, stay there. We have a series of higher lows coming off the bottom. Now, obviously, at this point here, the market is attempting to carve out another higher low. It's too early to tell if this is going to hold. We got to see how the markets close today. And more importantly, we got to see what the markets do next week. But these are the types of things from a technical perspective that we are always looking at. Now, when we look at some other areas of the market that tend to be market leaders, right? We look at the semiconductors, which is, there's many ways that you can follow the semiconductors, but the ETF SMH has been strong off the lows, and those are the types of things that we want to see if a rally is going to have some sustainability. And the semiconductors are companies like NVIDIA and AMD and Micron and the likes, and we know how important they are to the U.S. economy. So this type of action coming off the lows, semis have shown some strength. That's good, even in the last couple days after the Powell sell-off, right? The Powell pump and the Powell sell-off. Semiconductors have gotten back into gear here and are looking to move higher. So we want to see if the market follows them higher. When we look at interest rates, right, the 10-year yield still looks to us like a chart that wants to roll over. This is a very identifiable topping pattern when you look at it from a technical analysis perspective. And it doesn't mean that the 10-year yield is just going to plummet and go straight back into the 1% range where it stayed for many, many years. But this looks to us like an asset that's starting to roll over, and that is something that should be good for the stock market if this continues lower. And same thing when we look at the dollar. Okay, this is another chart to us, folks, that looks like It's starting to roll over here. As of right now, it made a high back in the end of September. And for the backdrop, just for informational purposes, a strong dollar and stronger yields are generally headwinds for stocks. So if we can get a weaker dollar and weaker yields, those should be tailwinds for stocks, right? So we dealt with the headwinds for the last 18 months. Maybe the market's ready to give us some tailwinds as well. So overall, when we look at the picture of the market, there's not a lot has changed since our videos, our updates last week. But when we look at, ultimately, the path for the market right now is kind of in a wait and see mode, right? Markets have come into this area. We tried to rally, we sold back off, and we're basically hovering around. And I think this is the market saying, all right, Fed, your move. Let's see what you got. And before we see from the Fed, we'll see what that CPI report looks like. So again, if any questions, always here to talk to you about the things that matter with your money. We'll be back next week to update you on the CPI and the Fed meeting, as those are sure to be market movers. Have a great weekend, and we'll see you next week.